Goodman Fielder makes bread, milk, and margarine, among other things. Now, you'd think that a company that makes staples could escape the global financial crisis unscathed. But think again. Morningstar Senior Equities Analyst David Walker is here to give us an update. David, thanks for joining us.
Thank you, Vicky.
David, first of all, could you give us a rundown of Goodman Fielder's businesses?
Goodman Fielder is the largest food play on the ASX. It makes and distributes staple foods like bread, milk, margarine, salad dressings, cooking oils and flour. There are operations in Australia, New Zealand and the Pacific Islands. And the business owns heritage food brands that Australians buy in the supermarket every day.
Of the stable of businesses that you mentioned, are there any weak links in the chain?
The weakest business unit is the commercial cooking oils and fats business. This business is commoditised, the products are largely unbranded, so there are no economic moats and there's no pricing power. Additionally, competition is increasing with the invasion into the market of multinationals with global scale and correspondingly low unit costs. So we're pleased to hear that the commercial oils business isn't part of Goodman's recently revised strategy and that the company is in advanced discussions with bidders for the business, and we look forward to an announcement about a sale.
So regarding that sale, has the company given us any timetable?
All it has said is that discussions with bidders are at an advanced stage. It has, however, said that it won't sell the business at a diluted price, so a sale isn't guaranteed. But we would expect that the intention is to sell the business.
In your recent report for premium subscribers, you mentioned margin pressure. Can you tell us any more here?
In 2009, Goodman's agricultural commodity cost base inflated by $116 million. This followed an increase of $235 million in 2008. So over the 2 years, the Goodman's raw material cost base increased by $350 million odd for a business which only earns $160 to $200 million. Then in the financial crisis and recession, consumers drifted away from the higher margin, premium branded products which had driven much of Goodman's growth in recent years and switched to cheaper private label brands and generics. So margins were hit from both ends. Goodman was able to recover some of the increases in its raw material cost base, and pricing power was a little better than we thought, pricing power with the supermarkets. But the company will remain vulnerable to any longer-term increases or any long-term bull market in soft commodities or even short-term fluctuations in soft commodity prices. Increases in commodity prices can be recovered by being passed on, but mainly when the increases are smaller and manageable.
Stock market investors have recently shown a keen interest in recovery plays. So is Goodman Fielder considered a recovery play, or is it not really on investors' radar at the moment?
It is a recovery play, and those commodity costs are falling, but we would argue they're largely already priced in. From here, the company has to lift market expectations the hard way by choosing the right bolt-on acquisitions, product innovation, brand support, and the extraction of further internal efficiencies.
So regarding bolt-on acquisitions, David, do you have any special categories in mind?
The areas the company is focusing on seem to change from time to time, but a successful acquisition in 2009 was Paradise Foods, which makes biscuits, and that was responsible for much of the sales growth of 7% that year. Has
the company signalled any expectations for this financial year?
Management says the 2010 outlook is encouraging, with the extraction of efficiencies to flow from the closure of obsolete high-cost plants and the commissioning of newer, lower-cost plants. Additionally, those commodity prices are falling, but the benefits won't flow in full until the second half of the 2010 financial year.
And David, do you have any expectations of your own?
Well, we would agree with the company's outlook, but would caution that, as always, much depends on the attitude of the major supermarket chains, and in particular, how hard they are going to negotiate with their food suppliers. They will want some of the upside as commodity costs fall. Woolworths has said that it is going to focus on suppliers which it thinks are earning excessive margins.
So David, given everything that you've told us here, what can investors take away from this today?
Investors need to understand Goodman Fielder is competing with several other suppliers in a mature market where the buyers are few and powerful. The company is more cyclical and less defensive than many investors might expect for a food stock. There's the dependence on low or steady commodity input prices, the fluctuations in consumer confidence. So in an average year, EPS growth should be about mid-single digit, so there are better growth stocks elsewhere.
David, thanks for your time today.
Pleasure, Vicky.